they're not looking like somebody that basically lives paycheck to paycheck is not looking for ways to pay their mortgage down in 7 years. They're in the system. They're on the hamster wheel, and they're probably never going to get off, unfortunately. And I think education is the key to helping people get out of that, get off of that hamster wheel. But it has to start with the desire, the curiosity. People that aren't curious about these things, they don't even look into this stuff, right? So you have to have those kind of things.
All right, guys, here we go now. It is time to unlock more doors to deals. We're real estate investors here. We're real estate agents here, and we all have one thing in common. We believe that we can. We can live the life of our purpose. We can create financial freedom. We can build a better life for those that we love, and we can live the life of our dreams. I don't care if you're trying to do your first deal or your 500th this year. You can get to the next level, and we're here to help. Welcome to Doors to Deals. I'm your host and founder, Jim Manning. Today's episode can be found on doorstodeals.com/082. Today we have a loan expert on the line. His name is Ron Bork, and he's with CMG Financial. And they actually specialize in a product that's called an all-in-one loan that puts your personal residence, the home that you own, into a home equity line of credit in the first position. So yes, that sounds technical. And yes, this episode is a little bit technical. And as a real estate individual, whether you're an agent or an investor, this type of information is important for you to be aware of. I love how Ron just challenges the belief that a 30-year fixed rate is the best product out there and the best thing for you. I've had the chance to play with their calculator online that they have on their website, and it's pretty amazing, depending on your financial circumstances, what a product like this can do compared to a 30-year fixed product. So anyway, this is going to be a little bit more technical and a little bit more focused on that kind of aspect than what a lot of our episodes are. And I think it's really valuable. So, and then a public service announcement, guys, like just so you know, here at Doors to Deals, our company's name is 3 Doors. The podcast name is Doors to Deals. And our main goal of what we're trying to achieve is to help 250 of our agents and their clients become financially free investing in real estate over the next 10 years. Currently, we've been generating about $150,000 per month in passive income for the individuals that are associated with us. If you're interested in learning more about how we can help you build passive income, go ahead and contact us at deals@3doors.com to learn more about that. So before we get started, let's check out the review of the week.
This week's review comes to us from AAA Invests, titled 5-Star 3 Doors. 5 stars. AAA writes, after checking out a few episodes, I felt compelled to leave a positive rating for this show. I really respect these guys from 3 Doors. AAA, thank you for your review. Jim, back to you.
All right, guys, no more talk from me. Let's get going on this interview. All right, guys, welcome to Doors to Deals. I'm your co-host and founder, Jim Manning. And today, my business partner, Jason Courtney, is on the line. And we have Ron Bork with All-in-One with us. And what's exciting about this is that when I first talked to Ron a few months ago, it really started to challenge some of the beliefs that I had on how mortgages work and what a long-term 30-year fixed rate does, and what's, and it really opened my mind to what some of the other products that are a little bit more well-known outside of the United States are. And I'm really excited to bring this to you guys, because it's something that whenever we can challenge the conventional wisdom, I think it's good for our minds, and it's certainly a really interesting product that they have. So I'm excited to bring it to you, and welcome, Ron. Thanks for coming on the podcast, man.
Yeah, it's my pleasure. Thank you very much for the invite. I'm kind of excited anytime I get a chance to share this information, because it does challenge people's perceptions of what they've been taught for many, many years. And I don't like to use the term brainwashing, but we are all very, very conditioned into thinking one way,
Yeah,
And so it's always exciting for me to impart this this information.
We sure are. And so, Ron, let's get into your background and your what's your work life like, and how'd you end up in the mortgage industry?
Hey, but before we do, Jim, I just want to preface this podcast by saying all those who are listening are going to be blown away. If somebody told you that you could pay off a 30-year mortgage in 7 years without spending an extra penny, would you say yes to something like that? That's what you're about to hear, folks. Just want you to know ahead of time.
Thanks for building it up, Jason. So now you got really,
we got to make sure they stay on here, Ron. Because we don't want them to miss this awesome.
But that's like saying, when you're about to sit down at a poker table, hey, I'm a really good poker player.
Disclaimer: Jason Courtney received $1,000 from Ron before this episode aired.
Hey, well, some of you guys.
No.
I will qualify this. What Ron's getting ready to share with you, I'm in the process of doing myself on my own personal home. So I just want to throw that out there. That's how much I believe in what Ron's doing, and I think you guys need to really.
And in all seriousness, just to make the attorneys happy, there is no kickback or anything like that. Jason doesn't receive any money for this.
It's actually one of the things, sorry to interrupt you, James, but it's one of the things that I just love about what I'm doing these days. It's like I do not pay any marketing fees. I don't do any marketing really, other than things like this, getting together with people that are talking real estate, financial advisors. There's some groups online that, sell coaching packages about these strategies. And I've reached out to them all. And I said, honestly, I really do have the best loan product when it comes to this type of a strategy. And, ultimately, if I could just say, at its heart, what we are talking about is the difference between what everybody thinks is such a good mortgage, whether that be a 30-year mortgage, a 20-year mortgage, or a 15-year mortgage. Oh, it's fixed. Oh, it's a fixed rate. That's so wonderful. Truthfully, it's not, because all you're doing when you are jumping into a loan like that is obligating yourself to a monthly payment that's going to last for, a third to a half of your entire life, and with absolutely no options to change any part of the terms of that loan during the entire course of the loan. If you ever do need to or want to change anything of that loan, there's only one way to do it, and that is a refinance. So those loans are called closed-ended loans, and they're called that for a reason. They're closed-ended. There's nothing you could do. You can pay extra principal if you like, and yes, that will save you money, but you will not feel it, right? If you pay extra principal, even a great amount, next month, you still have that same obligation, that same monthly payment. It will not change. If you pay extra, you're going to save on interest. But when do you actually feel that? When you sell or when you refinance? And the banks know this, all right? This is all by design. They want us in these types of loans. And the reason is, sure, all the listeners are aware that on a 30-year fixed rate mortgage or a shorter term mortgage, the bulk of the payment early on is interest, not principal. And the banks also know that chances are you're only going to be in this loan somewhere between 3 to 7 years. It's very rare that you come across anybody that's had a fixed rate mortgage for more than 7 years. It's really rare. I speak to people all the day long, right? And their situations. And I hardly ever see anybody with an older mortgage. It's really, really rare. And so what they got you in this trap because you're going to finance. They're going to convince you, oh, this is the way to go. It's a fixed rate, nice and safe, promote safety, right? They love to do that. Meanwhile, if you look at an interest rate chart for the past 40 years, what have interest rates been doing that entire time? All right, maybe not 100% of the time, but 80% of the last 40 years, interest rates were going down. And all that time, they were trying to convince us to take a fixed rate mortgage. Actually, these days, when interest rates are near the bottom, I would say is probably the first time that you could actually make a little bit of sense of locking in a fixed rate. But on the flip side of that is it's really unlikely we are ever going to see high interest rates. Yes, they're going to push them up over the next little bit of time here. Or maybe, usually when the Fed goes into their raising mode, it lasts for 6 months to 2 years. And then all of a sudden they have to reverse course. Either they've raised one too many times and they slowed the economy themselves, or some outside influence will drive down interest rates. The Ukraine-Russia thing is a perfect example. If this thing starts to escalate, which it looks like it already is, that's going to drive rates down. Any instability in the world drives rates down, not up. All right. Right now, the Fed is kind of forced into a corner because of inflation numbers have been ticking so high. So they feel impelled that they need to raise interest rates to slow down inflation. But what if inflation is just a temporary thing because of the end of the pandemic and supply constraints, right? I personally think that's all it is. I think this inflation, we are too tied to technology these days, and technology prices are always going down. And so to say that the entire economy is going to go through this giant inflationary period that's going to last for a long period of time, I personally don't see it. So that was a long-winded way of saying that.
I tell you what, if I can interject here, I don't know if we did. So we're kind of dancing around and we're talking about the topic.
That's what I was just going to get into.
But let's kind of like, if you can provide a little bit more context around. So we're talking about like a close-ended loan, which the close-ended loan again is a 30-year fixed rate, 3% or 4% fixed rate loan that you're used to hearing about. And the conventional wisdom is that this is, and some people think that that's really the only product to use, right? And then like what would be the best way to explain your product, the all-in-one product that you guys have?
Right. So thank you for that. I was just about to go to where these were closed-ended mortgages. And so what's the opposite of that? Well, that would be an open-ended mortgage. What is an open-ended mortgage? It's a line of credit. Your credit cards are basically lines of credit. They would be wonderful. Can you imagine if you could have a credit card with a $20,000 credit limit and the ability to draw cash from that without getting hit for these high interest rates? What if there was a credit card that you could get for your house? And the difference is the interest rates are more in line with traditional mortgages. It's still tax deductible, and you could pull out cash at any point in time that you want, and you could put deposits in at any point in time. That would be a line of credit that you can get for real estate, primary residence, vacation homes, and investment properties. And so with a line of credit, what we're saying is that you can actively push all sorts of funds into this line of credit, immediately lowering the balance, immediately lowering the interest charges, because all mortgages basically comes down to a daily interest charge. And so by having a line of credit in place of a close-ended fixed rate mortgage, what that gives you the ability is that you can now push a ton of funds into that line. You're reducing the interest. And every time you put $1 in there, it saves interest, but also creates $1 of available credit. And so this all-in-one loan that we'll talk about is a form of a line of credit that is put in first lien position on a property. This is not a second lien. This actually replaces what would normally be your first mortgage. And you put this in its place. And what happens now is you have all this flexibility, because I can move money into that mortgage to lower the balance, lower my monthly interest charges if I want that money back for whatever reason. It could be frivolous, but the way we sell it is, look, you could use this loan to drive down that balance and literally have it paid inside of 5 to 10 years. That's a 30-year loan paid off in 5 to 10 years. My average customer is done in 7.3 years. And I know that because we have a simulator online that you can actually punch in your numbers and see exactly how this will pay out. And so, and that simulator accounts for fluctuating interest rates too. So that's the basic gist, Jim and Jason. It's just that instead of doing a closed-ended mortgage on your property, you do an open-ended mortgage, and the difference is dramatic.
Ron, what I like most about the all-in-one is that right now in my current situation, I'm on a 30-year note. If I had a catastrophic event and I needed $50,000 and it was all tied up in my house, I would have to refinance my house. In fact, I'm in the process of doing that because I've partnered with Three Doors to pull out some cash for liquidity. And I'm forced to start that loan all over to get cash out so that I can use it for my investment business. And if I'm right, the all-in-one, I just write myself a check.
That's
Isn't that
exactly
right? I don't have to refinance. I don't have to go through an approval process. I don't have to start my loan all over again. I can literally just write myself a check for whatever equity I have available to me through my all-in-one. Is that?
That's exactly right. There's really only one reason you would ever refinance an all-in-one loan. And that is because after the 10th year that you have this loan, the credit limit, the total credit limit slowly starts to reduce over the next 20 years. So it is a 30-year loan. Like I said, most of my customers are done paying it in less than 10, but you retain access to the available credit, right? So if you start out with a $500,000 line that you have and you pay it off in 5 years, well, that means you have 5 years access to $500,000. At the end of the 10th year, it slowly starts to reduce. So somewhere in the years of, I don't know, from 15 to year 25, you may decide to refinance this loan just to get a larger line, because you should always, always, always have available credit at your fingertips. And the reason I say that is, and this is what a lot of people think, like, well, I have a lot of equity in my home, and if I ever need it, I'll just refinance. Well, there's the problem. If you ever really need it, you very well might be unmortgageable and cannot get that cash out refinance when you need it. I take this very personally because this is exactly what happened to me in the years 2009, 2010. My wife and I were in the mortgage business. We owned a company. That company, I mean, it somehow survived, but our income fell like 80%. We were stuck in these two mortgages, and there was nothing I could do because our income fell so much that I couldn't qualify for the balance that I had on the loan. Never mind taking cash out. It would have been impossible. And so I have now put myself in a position, and I recommend this for literally everybody. You got to have available credit. You don't know when some financial setback is going to hit you in the head. And now what do you do? So,
what I think about that, Ron, this is how they sell insurance to you, right? Health insurance. Well, you never know when there's going to be a catastrophic event, Mr. Smith, and your wife gets cancer and now you've got $1 million medical bill. If you don't have insurance, you're in big trouble, right? Mm-hmm. So these are the types of fear mongering, if you will, that happens with.
Well, it does, Jason. But the interesting thing about that is nobody really thinks about the fact that they should have insurance. Everybody realizes they should have insurance for that to happen, right? And so it's kind of almost like, yeah, I need insurance. But when it comes to mortgages, most people don't even recognize the fact that there are different types of mortgages available. They're just going with the status quo. And so they're winding up with these loans, really.
That's a really good question, Ron. Why do people not know about the all-in-one mortgage? Why is it that?
I have a good answer for you.
Yeah. I mean, all I could think of is that the banks don't make much money on them. That's why they don't like them. But
that's part of it. So when Jim first introduced me, he said from all-in-one. So my loan is all-in-one, but I'm actually with a company called CMG. And CMG is a very, very large mortgage banking outfit. We close over $1 billion of loans every month, not year, every month. It's a big outfit. They designed this product in 2005. Since that time, in all those years, 17 years, there's not been one single default or foreclosure on an all-in-one loan. That's incredible. And the reason for that is, unlike all other lines of credit that are out there, this one does not actually require a monthly payment. Because it's a line of credit, what happens is at the end of the 1 month, your interest is calculated. 21 days later, it simply falls onto the balance of the loan. And so if you have available credit, that's important, right? You have to have available credit. But if you have available credit and you run into a problem where you lost your source of income, you got sick, injured, I mean, any number of things could happen, this loan will literally pay for itself till you get back onto your feet, or until you use up all your available credit, at which point all that happens now is you do have to make the interest payment. But most people would never get to that point because they'll, typically people fix their situations, right? So if you think about it, CMG was offering this loan in 2009, 2010 when the world was coming apart, yet nobody defaulted on the loan. And that's the reason, because you can basically skip payments. I like to say, well, you could take a year-long sabbatical, travel the world, don't make a single deposit into this loan or payment, come back, you'll have a higher balance, of course, because the interest has accrued, but you never got a single letter in the mail saying, hey, you're in default. And I just find that to be incredible, because not only is the loan an amazing vehicle that will save you a ton of interest, it's also the safest loan that we have in America. There's no other loan that does this.
So,
Ron, I want to kind of throw the all-in-one out there and have you clean it up. But here's the way I understand it, which just blows my mind, is that we put this all-in-one is not just a mortgage. It's your checking account. It's your savings account. It's your retirement account, whatever. So you throw all in one. You throw all your money in one account. And the money going into this account reduces your principal obligation. And that's how you're able to pay this thing down as quick as possible, right? So I always tell, I have, Ron, I've got 5 or 6 friends, including my brother-in-law who already are on these loans, who is very, very close to paying his house off. And has only been in an all-in-one for 3 years, by the way.
Amazing.
I know he put all of his income in, and they live on his wife's income, which is really, set fire to the process. But all of your money is going into this account, and you have access to it. You have a debit card, just like all your other accounts, right?
That's right.
But the more you keep in there, the less principal obligation you have, which is what reduces. That's the power of the loan, right? It's all in one. Everything.
Yeah.
If your kids got a lemonade stand and they made 50 cents on that lemonade, they should
throw it in the loan.
Yeah, right.
Yeah, they could participate. The one caveat to that, I would say, Jason, would be retirement. Like, if you have a 401k, you have any kind of employer match, any employer incentives to do their retirement plan. I don't tell people to divert their retirement plan into this loan.
Sure.
Everything else, though, it's interesting. And it doesn't mean it wouldn't make sense. It could. You could say, let me reduce what I'm putting into my retirement, because the sooner I get out of debt, the better, right?
And I can put more into my retirement then. Once I'm out of debt, I can put more.
Once you're done. And see, that is a big key, guys. That is huge, because see, what we do in this country is, and the banks have us convinced this is the way to go. We have our main expenses. Our taxes come out of our check, possibly retirement. Then we get a net check. That net check first has to go to food, shelter, and clothing. And then whatever is left over, maybe, we can have some entertainment dollars. And then we still want to try to save some money on top of that for a vacation, or maybe I don't want to get a car loan. But see, this is what happens. You wind up having to get a car loan because you're paying interest your whole life. And so you're never able to actually get to the point where you could buy a $30,000, $40,000 car cash. We don't get to that. And even if we did, what happens? Well, we don't want to send all that money into the car, because now if we needed to use that money, we'd have to sell the car. And this all-in-one loan is kind of taking that whole process and how we are conditioned to think, and it just basically turns it upside down. Because with this loan, your monthly cash flow drives down your balance. So all the income that you get, let's call it take home pay, net pay, it goes into this checking account. The checking account is linked to the line of credit. So the day I deposit $1, that dollar gets transferred over to the line of credit, reducing the balance by $1 and saving the interest on that dollar. So every single dollar I deposit into my checking account, and I do it via direct deposit, goes right from my company, right into the checking account, right into the savings, into the line of credit. I don't need a savings account, don't want a savings account. Because if I'm paying 4% interest on this loan, every dollar that I put into it, if I'm saving 4%, isn't that like getting 4%?
Yep.
And where are you going to get 4% guaranteed with no risk? You can't get that in the market today. You're certainly not going to get it from a savings account. So why put money in a savings account when I can get such a much better return by putting it into my checking account, ultimately going into the line of credit? And so you're using your monthly cash flow to drive down the balance of this loan.
And this is like, especially like for the realtors and investors listening in, why this can get so powerful is if you get you hit on a flip, or you hit on a $1 million listing that sells, you make $20,000 plus. Well, what happens is then that 20,000 hits your all-in-one account, and now you owe $20,000 less of interest that you're paying now on that line. And you can very well then turn around and spend that money a month, like 3 weeks, 4 weeks later, but that's still 20 grand that you paid less in interest for several days. So
I know Ryan's not going to like this, but you can literally fund your flips out of your all-in-one. You know what I mean?
You absolutely. I have customers that do it. They have their primary residence, and they throw a line of credit on there. They throw all their money in there. Many people start out with available credit. I mean, typically we go to 80% of the value of the appraised value of the home. So any amount that you owe that's less than that, you'll start out with available credit from day one. And then you could use that available credit for down payments. I mean, I just did that April of last year, where we wound up purchasing a rental property for my son to live in with his two buddies. And I'll be honest with you, I mean, that 25% came from my line of credit, and it was almost like a slam dunk, because it enabled me to finance 100% of the purchase of that, still see a positive cash flow. I've already paid the 25% down payment back. So for my purposes, all I see is like 70% line of credit on this rental property that I am also pushing some money to, albeit not as much as I'm pushing into the roof over my head. But
hey, Ron,
I just want to finish that with one quick thought.
Sure.
That had that money, that 25% down, been sitting in a savings account, I don't even think I would have thought to buy the property, to be honest with you. But because it's all leveraged, man. It's 100% OPM, right? Other people's money. Boom. It really is my money, because I do have to pay it back. But being able to just finance 100% of that made it like a slam dunk decision. I gave him a break on rent and still see a positive cash flow. So it really worked out good. What was the question, Jason?
Somebody asked, what's the difference between this and a normal HELOC?
Okay, and that is this functionality. That's one of the main parts of it, the functionality of being able to, you can try to mimic what the all-in-one does with your own checking account and your own HELOC. It's work, right? You got to manage it. You got to constantly be transferring. Whenever you transfer, there's delays. This loan does everything automatically, and it does it at pretty much the same interest rates that you're going to see on regular HELOCs. The only difference is this is a 30-year loan, so you are going to pay standard closing costs like you would on a regular mortgage. But other than that, you are getting this automation, complete automation, so you don't have to manage it. You're getting a 30-year draw period, right? Other HELOCs, at the end of 10 years, you're done. And so now what? Now you back into that situation where I have to refinance, and that's
Right.
maybe it'll be easy. Maybe the stars will align at that point in time. But I always think back of like, if you had taken out a regular HELOC in the year 2000 and now it's 2010 and you need to find a new HELOC to replace that. Well, if you didn't know about CMG, nobody else was doing HELOCs at that point in time. Nobody. So that's a problem with those. And they all require a monthly interest payment, which this does not. So there's a few other advantages that I won't get into right now, but the all-in-one basically is like, if you want to call it the Tesla of HELOCs, it is the best HELOC out there. And I will say, though, that if somebody is sitting on properties that are free and clear, and they just want to have access to equity, getting a regular first lien, a HELOC in first lien position, a regular one, makes plenty of sense. Do it. As a matter of fact, I'm telling you, you should be doing that. Every property you own should have a line of credit, even if it's at a zero balance is great, right? But at least it gives you access to capital.
One of the things that I learned from, I've forgotten the guy's name. I know that you'll know, but the redheaded guy that's all over YouTube about first position.
Michael Lush.
Michael Lush, right? So back in the day when we had these HELOCs on our properties, the banks called them due, right? And said, okay, we're no longer giving you access to that money, blah, blah, blah. And so that was a fear of some people. But because this is a first position HELOC with the house as a collateral, this doesn't happen on this type of a loan. Is that right?
Hey guys, for those of you that are local to St. Louis, I wanted to make sure you knew about an amazing resource that we have to help do some extra deals. You can email our team at deals@3doors.com. And just so you know, we do deals with other investors all the time. Like, it's been hundreds and hundreds over the years, and we've averaged over 100 deals with other investors per year over the last 5 years. We can straight up buy the deal if you have a wholesale under contract that you want to sell. If you need funding to finance a flip, or like you're doing a BRRRR strategy, we have funding available for you. If you're trying to wholesale a deal, we're doing JV wholesale deals with other wholesalers that, quite frankly, some of the deals we're putting together for a beginner or an intermediate investor, they'd probably be walking away from because we have systems and processes, and we have buyers in place that are paying top dollar for these properties. So make sure you use this resource. And the best way to get and the easiest way is to just send us an email, deals@3doors.com. All right, back to the episode.
Back in the day when we had these HELOCs on our properties, the banks called them due, right? And said, okay, we're no longer giving you access to that money, blah, blah, blah. And so that was a fear of some people. But because this is a first position HELOC, with the house as a collateral, this doesn't happen on this type of a loan. Is that right?
Yeah, I'm glad you brought that up. It is a big worry of a lot of people that first come across this. Like, oh, I heard they freeze these, and every line of credit in the country has provisions in the agreement that it can be frozen. If you make a late payment, I mean, it's kind of weird because there is no payments on this really. It's kind of impossible to make a late payment, but late payments, a severe drop in value, the lender does retain the right to limit the draw. But the interesting thing with this loan is like I said, they've had it since 2005. There's never been a single freeze of any draw. As a matter of fact, I've never heard of any HELOC in first position that got frozen. I've never heard it. Second position, yeah, it definitely happened, and it happened to me and a lot of my customers, because back then I was teaching that. I was showing people how to use a second position HELOC to drive down the balance on their first lien. And I thought, well, this makes perfect sense. And it did until it didn't. I don't think we have that issue with this loan. I also don't see anything like what we underwent in that period, '08 to 2010. That was a once in a lifetime deal where, lenders just went berserk with lending standards. And
Well, I know that there's also, you guys are getting ready to open it up to do at least one investment property, maybe more. And a good friend of mine that you helped out, it's in Florida, Kyle, he says, Jason, you don't need to. You just use the first one for every one of your investment properties. You just throw all your money into it, to pay off the other investment property. And so I asked you, what would be the benefit of having to? And you said it's simple. It's more available credit. So if for some reason you wanted access to more equity, then you would do an investment property.
Well, what I like about having two, and you're right, we were limiting people to only one, and we just opened one per customer. Let me put one rental property all in one per customer. Now we've opened that to two. So you bring up a great point. Why do I need two? And I would just say that the second one gives you more options. It enables you to kind of run in place, if you like, meaning that, just throw the interest in there and take whatever positive cash flow you have on that rental property and throw it into either the roof over your head or another rental property that you have. I like this I always tell people, I get a lot of people that will say, well, I want to try it on my investment property first. And that's fine, but I disagree with it. I say, get the roof over your head paid for. That does not have cash flow, right? It's cash flow. Your regular income is your primary residence's cash flow.
Wouldn't it make sense, though, to take the available credit out of the rental and throw it into the all-in-one on your personal residence to get it free and clear quicker?
I would say absolutely. And again, that's why having two gives you that flexibility. A lot of people, you talk about the tax ramifications of this, right? Your interest on your rental property is always going to, it's tax deductible, right? The roof over your head, it's still tax deductible, but most people don't even take that deduction anymore because in 2017, when the tax code was revamped, the personal exemption increased to $24,000. So unless you have interest costs and other deductible expenses and you're actually itemizing, you might not even be deducting the mortgage over your head, right? So it would make more sense that I'm leveraging my rental property where I do get that tax deduction and getting the roof over my head paid for.
Hey, Ron, can I interject here?
Yeah.
Something that's kind of going on in my head that we might have some listeners kind of thinking the same thing. So there's a lot of benefits. There's a lot of great things to this. Are there any risks to doing it this way, or any areas to avoid on a loan like this versus just the traditional fixed rate loan?
Yeah, that's a great question. You do need some discipline because you're going to build up available credit rather quickly. And if you're constantly look at that available credit like, hey, I could buy more stuff, well, that's not really how the loan is designed. The loan is designed to help you get out of debt. Now, if you convert that available credit into income producing or appreciating assets, it's a different story. If I'm paying 4% for this money, well, all I got to do is beat that return on whatever investment I'm going to do. And so the people that are focused on wanting to drive down their debt levels, also increasing their net worth via rental properties or businesses or whatever you have, whatever it is, those people are going to do really, really well with this. The people that just, what I find is people that aren't good for this loan don't ever even discover it. They're not looking, like somebody that basically lives paycheck to paycheck is not looking for ways to pay their mortgage down in 7 years. They're in the system. They're on the hamster wheel, and they're probably never going to get off, unfortunately. And I think education is the key to helping people get out of that, get off of that hamster wheel. But it has to start with the desire, the curiosity. people that aren't curious about these things, they don't even look into this stuff, right? So you have to have those kind of things. So I would say, sure, discipline you need. Make sure that it's somebody that you have a positive cash flow in your household. If you're running month to month, this is not for you. Some people will say the risk is, well, it's a variable rate interest rate. And to that, I could talk for an hour, but I'll just minimize it to this. It's highly unlikely we're ever going to see really high interest rates again, not when we have $35 trillion in government debt, right? The last time interest rates went really, really high back in the 80s. And literally, if you look at a 100-year or 200-year chart of interest rates, the early 80s, it looks like a needle sticking up. I mean, it's literally was a one point in our history that we had just recently come off the gold standard, and the presidents and the Fed, they didn't have a good handle on it. And then Volcker came in and increased interest rates sky high. I can't see that happening when we have $35 trillion in debt. Back then, it was like our debt was like, 30% of GDP. Now it's 140% of GDP or some crazy number like that. So I think the worry over interest rates is not a worry that you really have to worry about, because what this loan does, it takes the impact of the interest rate that you're paying and dramatically minimizes the impact. And that's the big key to this loan, right? Paying the amount of debt that you take on, you should be not thinking about the interest rate, but you should be thinking about TIP, total interest paid. That's the important part. But in any mortgage, anytime you've ever spoken to a mortgage guy, have they ever talked about total interest paid? They don't want you thinking about that. They want you thinking about the interest rate, because they want to sell that 30-year fixed. And that goes back to what you asked earlier, Jason, that I don't think we completely answered.
Yeah, I'm sorry. Go ahead. Go ahead, Ron.
Oh, just that we didn't really answer like why this loan is not really that well known. First off, CMG is the proprietary creator of the loan. So it's not all over the place. That's one thing. But also in my own company, I was starting to get to this when I said we close over $1 billion of loans. My own company has approximately 800 loan officers or so. Only a small percentage even sell this loan at all. Why? Because we get a haircut on the commission, about 33% haircut. We make less than a regular mortgage. And the way that most people look at it, loan officers, is that I got to explain this whole thing. I got to try to convince somebody to do this. They could just quote a 30-year fixed rate. Boom, next customer, right? They could just do so many more loans than this loan. And so that's why they stay away from it. Personally, I look at it a little bit differently in that I'm really helping change people's lives. I'm having a huge positive impact for people. I hear it all the time from customers that I've closed. They are having success. And you know what? They refer me more business than I would if I was talking 30-year fixed rates. I know that side of the business. I don't like it anymore. What I'm doing is really, really helping people. So I'm not just helping you acquire debt, I'm helping you get out of it too.
So Ron, you kind of sparked a little Google search for me really quick. I typed in a 200-year interest rate historical chart, and what came up, now I haven't fact checked this, guys, because we know everything's accurate on the internet when you get it right away. But what came up was that the average interest rate over the last 200 years has been 5.18%. 5.18. So one of the things to like I love it. So you said total interest paid versus interest rate. So if you guys think about this, and then if we add in a credit cards into the conversation, okay, and let's say you have $10,000 of income come in during a month, and you have 10,000 of expenses. Let's just say you're break even, okay. So you're just net neutral. If I get on the first day of the month, I get $10,000 come in, that then automatically makes my mortgage balance go down $10,000. And then I pay my $10,000 of expenses over the next 30 days that I then don't have to pay off for an extra 30 days. Well, that's actually a 60-day spread there where I'm paying $10,000 less of interest. So there's an investing term, and Wayne, we just had Wayne on a couple of weeks ago, Wayne Paprocki, and he was talking about using a sweep account where you do this strategy, but you have to manually do it. And you have to, and you use an actual HELOC as a way to do this and pay down and just basically pay down the balance more quickly and then pay less interest, right? So that's one of the things that when I heard about the all-in-one, I was like really impressed with, is that it automatically sweeps for you. It automatically pays down the balance, and then you pay it off. And if you just do that, I mean, Ron, what are the numbers like if you're at a break even on a cash flow on a monthly basis on a 30-year loan? Like how quickly are you seeing these all-in-ones get paid off versus like a 30-year?
So 30 years, basically, I think the average is they never pay them off, right? Because who holds a mortgage to the end, right? I mean, that is so rare. You have to not only be in the house for all that time, but never refinance. And that just never happens. So I would say that, and they used to say that an average age of a 30-year mortgage was 7 years. That has come way down because with the pandemic reducing interest rates, I mean, right now, probably the average 30-year fixed rate is probably, I'm going to guess, if you took every mortgage in the country, that's a 30-year fixed rate, I would bet you that out of all of them, they would probably be averaging about 3 to 4 years that they're holding these loans. And over that 3 to 4 year period, you're going to knock off about 10% of the principal, maybe 15% of the principal. That stinks. I mean, that just stinks, right? And then you're going to get another 30-year fix. You can start all over again. And that's the reason I'll tell you guys that the preponderance of people that I speak to are in their 50s and 60s. And the reason for that is, I think, when you hit 50, all of a sudden you start thinking about retirement. I'm not that far away from retirement. I got to do something. And they start investigating, and they come across Michael Lush or somebody on the internet talking about this. And they look at it and they go, yeah, I could do this because my income is plenty, right? There's a lot of money left over at the end of the month. If I can use that to get out of my mortgage in the next 5 years or so, how great would that be? And I would say that the people that do find out about this in their 20s, 30s, and 40s are way ahead of the game. Way ahead of the game. If they get into this type of loan now, they won't be calling me when they're 50 or 60. Well, because I'll be dead. But
So your calculator's a lot of fun. I kind of on y'all's website, I was just running scenarios on it just to kind of, I guess I just nerd out on stuff like this. I don't know, but
cool.
So I do have some numbers. So a $500,000 loan, if you're net positive, if you're making a $3,000 surplus of income every month compared to your expenses, I have here, instead of it taking 30 years to pay off, it's 8.7 years to pay off, with a total interest. What did you say? Total interest payments.
Total interest paid.
Total interest paid of $144,000 saved compared to a 30-year fixed rate. Do you have any?
And I would even say that it's probably better than that, Jim, because I've used the calculator a few times without Ron, and I missed a few things. So I thought that I was going to be able to pay down my house in, I think it was 11 years based on my surplus. And then going through it with Ron, it was 7.2 years or something like that. So there might be something on the calculator that you're doing wrong that would make, because it sounds like to me with $3,000 of surplus, you should be able to pay it down a lot quicker than 8 years. Don't you think, Ron?
Yeah, there's a few things in that simulator that aren't accounted for. First off, it uses an interest rate that is higher than the interest rate that we're offering today. So it's a conservative result. Number two, it doesn't account for pay raises in the future. It does account for if you have money sitting on the sidelines that you can then make a lump sum deposit after you close to drive down the balance. It does account for that. You can put that information in there. But one of the most interesting things that I find about this is that it's telling you how much interest you saved. And I would like to see another screen on that simulator. I asked for it when the new version came out. I was disappointed that they didn't put that in there. But I would like to calculate out now, at the end of that 8th year, right? If I take my current principal and interest that I'm refinancing out of to get into this loan, take that and now do a how do you call that? Like a calculation on that money that I no longer have to pay for 22 years, right? If I just finish this loan, get it done, and now take my principal and interest payment and put that into a savings account or an investment of some sort, you're looking at multiple hundreds of thousands of dollars usually. So the combined effort between what I save and now what I'm able to invest because I no longer have a mortgage payment, it usually comes out for people somewhere between $400,000 to $1 million. So it's really, that's why I call the loan is a life-changing loan. Changes your life.
I think that's why Jim said we got to get Ron on here, because it follows suit with the vision of Three Doors, to help people become financially free. And so,
one of the things that I plan on in my future is I would like to create a website called Mortgage to Wealth. And because when you have a loan like this, first, yes, it reduces your interest dramatically, but at the same time creates available credit. And you can use that available credit, if you're smart about it, use that available credit to really create wealth, whether that be, real estate, obviously. I get a lot of people that, they're done with the corporate rat race and now they'd like to maybe buy a franchise or something a little easier or a little closer to home, whatever the case might be. Well, how do you do that? You go out and get SBA financing, which is a total drag. But, what if your house can finance the acquisition of a business? I mean,
well, I think there's 3 real benefits here, right? So one, you no longer have a mortgage payment. So let's say you've got $2,500 of additional money that you can invest in whatever you want. You still have a $500,000 line that you have access to if you want to invest in. Let's say you're paying 4.5% for the line. If you can invest it and make 8%, you can grow wealth that way. So not only are you reducing the interest you're paying, right? There's income number one. You're no longer have a $2,500 a month house payment, income number two, and you have $500,000 of available credit you can invest in something that makes you an 8% return, which is an additional 4% on top of what that loan is costing you. Jim, I'm thinking about people that own free and clear properties that get into these all-in-ones that we can use their money for funding. You know what I mean? It'd be brilliant.
Yeah. So Jason has the 8% there. That we that's a return that
or 12 or whatever.
Yeah, I have people that do that. They do their own little private lending, but I would like to maybe refer them off to you. If you have plenty of your listener base is coming to you for short-term financing, this is a beautiful vehicle to do it. And think about it. You're doing what the banks do to us, right? They take our money, they give us 0.25% on a savings account, and then they're going to loan it back to us in the form of a long-term mortgage at 4%. That's what they do. And that's what we could do now.
Yeah, it is wild to think about. And I think this was maybe on your all's website when I was kind of looking through the literature. It's just a common practice. You want to have some savings, whether that's 6 months savings, that might be 50 grand for some people when you have 4 kids and, a lot of expenses like I do, or it might be 10 grand for a single person or whatever it is. Right. But that's money. Let's say it's $50,000. It's money that you then give to a bank that then takes that money and turns around and lends it to people. Right. And they make their money on that. That is separate from your mortgage bank account, from your mortgage. So even though you have a 50K worth of savings, it's not lowering the amount that your mortgage payments have to be. It's not lowering the amount of balance. So it's really it's kind of like, I don't know why double taxation came into my mind, but it's almost like that. It's almost like that, right? Where it's well, you have that money, and you need that money with the typical loan because you don't have that liquidity if you just start dumping it into and paying down the house mortgage as quickly as you can.
Yeah, that's exactly right. I mean, two other areas that are like pet peeves of mine that people waste their money on this all the time. One, I hate when people say, "Oh, I get a nice big fat refund from the IRS every year." Oh, okay. So basically, you're saying you gave the IRS, or the government an interest-free loan, and now you're going to get it back at the end of the year because you're such a bad saver, and that's a forced savings. Okay, I can kind of get it because it forces you to save, but it's not a good deal financially. And the second one that's more closely aligned with this loan is an escrow account, right? I mean, the banks take our interest and our taxes. They take 1/12 every month. They hold on to that money. They can do with it whatever they want because it's on their account now. They can loan that money out if they want. They just have to have available when that tax bill comes due. Well, why aren't you doing the same thing? With this loan, you can, because we never escrow on this loan. You pay your own taxes and insurance. But meanwhile, so then people go, "Oh, well, that means I got this big bill that comes up once a year." Yeah, but in the meantime, that is money that's sitting in the account saving you interest. What is it doing it for you on a regular mortgage? One thing and one thing only: easier to budget. That's it. But with this loan, it's just as easy because that money sits in the account, grows my savings, and then when the bill comes due, I pay it out of the account. Boom, done.
Yeah,
I have shown
funny.
people.
I actually had my brother-in-law call me and say, "Hey, I just got this big tax bill and my insurance premium came in all at once." I said, "Oh man, how are you going to pay that?" And he's like, "I don't know." I said, "How about you write a check out of your all-in-one account and pay for it?" He was like, "Oh man," he hung up on me. I was,
that's right.
Stupid,
He just for 11 months wasn't paying interest on that money, right?
It reduced
it wasn't coming out of his, I like to say that in this country, what we do is we segment our income, right? So I started on it earlier where money goes to taxes, retirement, blah, blah, blah. And then for all the things we buy that we get a financing on, now we have to make room for that payment, and then that payment, and that payment. And escrow is it's another payment. Sometimes it can, depending upon where you live in this country, it could be 50% of your total mortgage payment. What's on my head there? Oh, that's my head.
So, hey, Ron, like a normal HELOC will lend you 80% like loan to value less whatever the note is. How does that work with all-in-one? Now, obviously, there's only one lien. It's this all-in-one HELOC, right? So,
yeah.
Do you guys go 80% or like up to 80%, or what do you guys go up to?
Yeah, it varies a lot depending upon the situation. So, if it's a purchase, right, you could use this as a purchase money mortgage. We can go as high as 90% on primary, 80% on vacation, 75% on rental properties. If it's a refinance and you're cashing out, then it's 80% on primary residence, 80% on vacation homes, 70% on rental properties. So there are some difference depending upon, what it is that you're looking to do. When I say cash out, I mean that you want your line of credit to be in excess of the payoff of your mortgage plus the closing costs, give or take a few grand in there that we can squeeze in there typically. But beyond that, like if you're asking for a line that's $50,000 greater than your payoff, that's considered a cash out refinance. If it's not a cash out and you don't have the equity, then we can go to 75% on a rental property too.
So it's going to typically, if there's any sort of equity in there above the 20%, it will be classified as a cash out refi from your guys' perspective. Okay.
Yeah. More than like a couple of thousand going back to the customer, go to the borrower, then it's considered cash out, and then 80%, 70% are the maxes.
Okay. All right. Well, I mean, that's really, I'm kind of out of questions. Jason, you got any more, or should we wrap this up, buddy? What do you think?
No, I think, Ron answered all of mine. I know a couple questions came through. I think that was just really the what's the difference between this and a regular HELOC?
Yeah, let me throw out one other thing that's kind of cool about this loan. Again, it has to do with flexibility, but beyond that, when it comes to qualifying for other loans and mortgages, having these loans is really great, because what we report to the credit bureau as a monthly payment is just your interest charge. Whatever your last interest charge was, that's what's reported, versus a regular mortgage that has principal built into it. So when you're qualifying for debt to income ratio, it makes it, you can get a lot more for your money, because like when we're doing an all-in-one and you have a line of credit on another property, then we're just going to use what's being reported. And that typically is, again, you have to watch with certain HELOCs. All HELOCs are not interest-only loans. Some of them force principal repayment. The all-in-one does not. So we're just telling the credit bureau what your interest charge is, and that's the number that other lenders are going to then use, qualify you debt to income wise. So that could be really helpful. It also becomes helpful, like it happens many times. Like I've got a couple customers doing this right now where they're moving their primary residence, but because we're reporting such a low payment on their current primary residence, they can now qualify to close on the new primary residence prior to having to close on the old primary. They now are able to qualify carrying both homes. And so now you can basically move and then put your house on the market, which is really, really helpful, because it takes all the timing issues out of the way, and then you don't have to have people traipsing through your house when you're still living in it. So those are two extra benefits too of having this.
Yeah, or if you're like Jason and I, you just rent it out. Don't sell it.
Or that.
Rob, I did have one other question I forgot to ask you. When I watched the video initially on this loan, it said that your available credit line stayed the same for, I thought, 20 years, and then it started to decline in the last.
No, it stays the same for 10, and then it declines over 20. So you could basically say that, you will have 50% of your initial available credit, or I should say your initial credit limit. You'll have 50% of that at the end of the 20th year.
Okay, so 100% of it for 10 years, and then 50% at the end of the 20.
Yeah, so they just basically take the balance, right, the credit limit, divide it by 240, because there's 240 months left in 20 years. And that's the amount that the total credit limit reduces. And the reason they do that is to avoid having anybody have a big balloon payment. You can't have a balloon, because you could get into a position where they are actually forcing some principal repayment if you have a high balance then, right? So you could have to pay the interest plus that 1% reduction that is required, right? So that's how there can be forced principal repayment in the future.
So the one thing that, because I'm in the process of doing my all-in-one now. So one of my concerns is that I believe my house is going to appraise for another $50,000 to $100,000 more next year than it does this year. And so, is it simple as doing another appraisal and increasing the line if I choose to, or do I have to go through the whole process?
Yeah, I wish it was that easy, Jason, but unfortunately, you have to go through a refinance. I have that situation myself, right? Like I look at my line, I could easily get another $200,000 added to it right now because of the value of my property, and I'm considering it. Really, I'm really focused on getting to a zero balance, because I'm a lot older than you guys, and I need to have no monthly payments.
Well, Jason's older than he looks, though, so don't
watch it, Jim.
Oh man. Well, hey, Ron, how do people get a hold of you? What's a good way to contact you if anybody has any questions?
So 2 ways. My website, if you want to just put in an application, which I don't recommend, get in touch with me first. But my website is mrheloc.com, MRHELOC, no period between the two, just straight out, Mr. MRHELOC for HELOC.com. But to schedule an appointment with me, I have an online scheduler at ronbork.info, RONBORK.info. And right there, when you go in there, you'll see initial consultation, It's going to ask you a few questions so that when our call comes, I will have some basic information of what you're looking to do, and we can jump right into a nice conversation.
All right.
Thanks for coming on, Ron.
Thank you for coming on.
Hey,
man.
it's my pleasure. Thanks for inviting me. I love what you guys are doing. I think, our interests are aligned, right? We just want to help people. And, I look at, like we talked about, that you make a little less money on this loan. Well, that's okay, right? And it's about helping people. And the more people that you help in this life, I think the greater your lifetime has been.
Okay, that's a wrap, guys. For additional resources, once again, go to doorstodeals.com/082. And just a reminder, if you need cash for funding, Three Doors has access to that. If you're a wholesaler trying to put deals together, we can help you put together deals that maybe otherwise you might think are dead. So just send us a note to deals@threedoors.com. And if you're an agent just trying to get into that investing game, man, we got a lot of resources for you too. So don't forget, if you're out there on your own trying to figure this whole thing out, we can help. And we help people just like you crush their fears every single day, and we can help you get to the next level. So go out, live your purpose, and above all else, go after your dreams. Till next time. Thanks for tuning into this show. For more episodes and resources that will unlock doors to deals, check out our website, doorstodeals.com.